Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
All right, let's jump right in. We have to confront the controversy around Baytex Energy Corp., ticker BTE. Specifically, what has happened since that transformative divestiture of the Eagle Ford assets back in December of 25. That $2.14 billion deal was supposed to reset everything, but the market is, well, it's acting like it just doesn't matter.
And that's the whole debate, isn't it? That divergence is what we need to unpack. The stock is floating around, $420 to $440 right now, and the valuation is it's deeply distressed. You're looking at maybe 2.2 to 2.5 times EV to DAF, but the key is to look under the hood. There's some serious technical friction here.
You mean the short interest?
Exactly. Short interest is sitting at over 23 million shares. And more importantly, the off-exchange short volume ratio, the dark pool activity, is tracked at a really high 42.82%. I mean, that level of institutional betting suggests the smart money is cautious, not chasing some easy arbitrage.
See, to me, all that technical noise is just obscuring the fundamental signal. When you benchmark BTE against its Canadian heavy oil peers, I mean, look at Tamarack Valley, trading near 4 times, or Whitecap, comfortably over 5.5. That discount is just indefensible. My position is simple. This valuation gap is a temporary, completely actionable arbitrage opportunity. It's driven by market perception lag, and the price will correct.
And I find myself looking at the exact same data and coming to the completely opposite conclusion. I'm arguing this discount isn't some market error waiting to be fixed. It's a justified penalty. Selling the Eagle Ford, yes, it cured the debt problem, but it also stripped the company of its most important diversification tool. It has dramatically increased Baytex's single basin risk, and the market is, I think, correctly pricing in that new higher risk profile.
My entire thesis really comes down to this idea of the clean slate. This wasn't just a small fix, it was a total structural transformation. The $2.14 billion in proceeds were surgically deployed. They redeemed the high-interest 2030 senior notes, and they tendered for the 2032 notes. That one move eliminated nearly $100 million in annual interest expense. From an economic standpoint, this deleveraging is why the corporate sustaining break-even price is now down to about $52 US per barrel WTI.
Okay, just a quick clarification for everyone. When you say WTI, you mean West Texas Intermediate, the U.S. benchmark, and WCSB is the Western Canadian Sedimentary Basin, which is where Baytex is now, 100% concentrated.
Correct. And that $52 WTI break-even, that is a margin of safety that the old Baytex, the one buried under debt service, simply never had. And this has profound implications for free cash flow. So at a pretty reasonable mid-cycle price, say $70 WTI, the estimated free cash flow is between $550 and $650 million Canadian. At the current share price, that works out to a phenomenal 16 to 19% FCF yield. That level of cash generation has to fuel an aggressive buyback and force a re-rating. The cash is just too powerful to ignore.
I will certainly acknowledge the balance sheet repair. It's impressive, no doubt. But the transition has fundamentally changed the risk calculus of the company. The valuation gap, trading near 2.2 times enterprise value to debt adjusted cash flow, which is really the best metric for these companies. It reflects this new reality. The core risk is the total loss of geographic diversification. Baytex is now completely exposed to the volatility of the WCSB, and that brings 2 immediate problems.
Okay.
First, they've lost their natural hedge. Their U.S. assets were a counterbalance against widening Canadian crude differentials. That's gone. Second, you have this persistent overhang of federal regulatory uncertainty in Canada, the emissions cap, for instance. That is now an inescapable, non-diversifiable risk. And look, the credit market already sees this. Moody's downgraded the corporate family rating to B1, which directly reflects concerns about the firm's reduced scale and the stability of its cash flow, now that it's all coming from one single exposed basin.
That's an interesting way to put it, though. I'd frame it a bit differently. I think you're focusing very heavily on macro basin-level risk. And maybe you're underselling the sheer operational excellence of the new, focused portfolio. The core of my argument is that the issue isn't asset quality. It's the market's perception of a risk that has, in reality, structurally diminished.
How so?
Well, the company is now concentrated on extremely high-quality, high-return assets. You have the heavy oil development in Peavine and Peace River. The efficiency there is top tier. They use open-hole multilateral drilling, OHML. To be clear, that's a technique that lets them drill multiple horizontal legs from one well, maximizing contact with the reservoir while minimizing cost. The break-evens on those specific wells are often below $45 WTI.
Right, but I'm not really convinced by that line of reasoning, because while the Blue Sky Formation is great and OHML drilling is efficient, that efficiency is sort of moot if your entire product stream gets discounted because of pipeline issues or new regulations. You say the WCSB risk has diminished, and I agree the TMX pipeline expansion is a game changer. It reduces reliance on the U.S. Midwest, but TMX is a fixed piece of infrastructure. It doesn't eliminate macroeconomic volatility.
But the market needs to appreciate the permanence of that change. The physical capacity has dramatically altered the ceiling on how wide those differentials can get. So while it's reversible, the structural bottleneck has been largely fixed. I think what that B1 rating reflects isn't an assessment of asset quality, but skepticism about Baytex's scale post-divestiture, and that's an issue that the massive cash flow generation will quickly cure. The market is just lagging the reality on the ground.
I see it differently. I think the B1 rating reflects skepticism over the durability of that cash flow stream in the face of basin-specific risk, regardless of how efficient the drilling is. When you lose scale, you lose negotiating power, you lose redundancy. The market is demanding a higher risk premium for that concentration, and that premium translates directly into the low multiple we're seeing.
Okay, well, let's shift the focus then. Let's talk about the mechanism that, regardless of macro noise, should force the share price higher, the capital return strategy. This new model sticks to the value over volume mantra that investors have been demanding. They're targeting a modest 3 to 5% growth, and crucially, their capital intensity is projected around $9,000 per flowing barrel of oil equivalent. That puts them in the top quartile of their peers. That efficiency is what directly fuels the FCF yield we talked about.
So you're basically advocating for a convergence trade. You believe the overwhelming financials will just compel the market to re-rate the stock.
Precisely. This high yield must lead to the multiple compressing towards its peers. I mean, if it just converges to Tamarack Valley's 3.8 times multiple, which is still well below Whitecap, that implies a 50 to 60% upside from here. And this isn't theoretical. It's being enforced by their strategy. The explicit commitment to buy back shares will mechanically reduce the float and tighten that spread.
I just have to challenge the whole premise of that projection. That very attractive FCF calculation, your entire thesis, it relies on two crucial execution points in the field, both in the WCSB, and neither is a guarantee. First, it relies on flawless, predictable operation in the Peavine manufacturing mode. And second, it relies on achieving a highly ambitious 30% compound annual growth rate in their Pembina Duvernay light oil play. The Duvernay is the essential growth wedge here.
And the leadership is experienced in managing exactly those risks. The assets are well understood.
I don't think the risk is fully mitigated. The Duvernay, especially the rapid growth phase Baytex is targeting, is technically very challenging. If execution stumbles even a little, that high FCF narrative completely collapses. And we have a perfect recent example. Look at what happened with Varen Inc. in their Gold Creek area in late 2025.
Remind us, because that comparison is key.
Varen, formerly Vermilion, had significant drilling setbacks in a major growth play. The market punished them severely because it showed that even with great assets, the transition to aggressive manufacturing growth is full of risk. If Baytex can't deliver on that 30% CAGR immediately, the cash flow profile you're projecting gets deferred or maybe even invalidated. The market is waiting for data, and that waiting period is priced into the current discount.
That's a fair point on execution. But let's look at who is doing the executing. My final point is on leadership and governance, which I believe warrants a premium. CEO Eric Grieger is the architect of this pivot. He's known for his disciplined, returns-focused mindset from his time at Civitas Resources. This is a capital allocator, not an empire builder. And governance is tight. The CEO has to hold 5 times his base salary in shares. That minimizes the risk of empire building and warrants a valuation premium.
That is a compelling argument about management. I'll grant you, but it overlooks one key market concern: the cost of this entire metamorphosis. The company bought the Eagle Ford assets, held them for just a few years, and then sold them.
That's flexibility. That's responding to the market.
Or as it suggests, very high transaction costs, advisory fees, and strategic pivots that dilute shareholder returns in the short term. The market might not just be punishing the current state, it could be punishing the process of transformation itself. And we also have to talk about the competition for capital. You mentioned Whitecap Resources trading at 5.5 times. It has a long, stable track record and pays a higher, reliable dividend. Capital seeking stability is naturally going to favor Whitecap over Baytex's implied growth potential. Baytex has to earn that stability premium.
But the difference is that Baytex offers explosive potential. You're trading certainty for a 50 to 60% upside scenario. Whitecap can't offer that. That discount is the opportunity.
So we're left with a classic tension then. To summarize my position, while Baytex has cleaned its balance sheet, the market is, I believe, appropriately factoring in the new risk profile: high exposure to WCS volatility and significant execution risk in the Duvernay. The technicals, like that 42% dark pool short ratio, suggest institutional caution is warranted until performance stabilizes.
And I'll reiterate my core thesis. The discount is a temporary lag in perception, divorced from the fundamental reality of the balance sheet and operational efficiency. The low $52 break-even, the top quartile capital efficiency, and the immense FCF leverage justify an immediate re-rating. Trading at 2.2 times while your peers are at 4 to 6, that can't be maintained. The share buybacks are the catalyst that will close this arbitrage gap.
So the central debate remains: it's the strength of the balance sheet versus the concentration of basin risk and the burden of execution.
Exactly. The potential return versus the execution burden. The material clearly shows the value unlocked by the sale, but the market requires proof that this new concentration risk can be managed. Further exploration of BTE's performance across the upcoming 2026 budget cycle, especially in the Duvernay, will be essential to determining which argument wins out. The market is waiting for the data to finally catch up to the fundamental.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching, and see you next video. Bye-bye.